still chiming in here. But yeah, let's kick the meeting off. Just want to thank you all on happy Friday here before most of us are going to have a family day weekend. We're excited to have Francis Donald join us today. And I want to kick off the meeting introducing Rahim Para from our group retirement business, our Vice President of Group Retirement. And he's going to do the introductions. Thanks, everyone.
Perfect. Thank you, Leo. So once again, thank you everyone for attending. I'd like to start off by formally introducing Francis Donald of Manulife Financial. Francis is the Managing Director, Global Chief Economist, and Global Head of Macroeconomic Strategy. Having heard Francis speak at various industry conferences, as well as in the financial media, I can honestly assure you that you're in for a treat. This will be a great conversation. Also wanted to, shamelessly plug Francis's Twitter. She's a must follow on Twitter for anything to do with the economy, as well as her most recent TED Talk, which you can access through YouTube. A lot of great content. So thank you, Francis, for making yourself available for today. We really appreciate it. As for the format of our discussion, we'll do this in a Q&A format. We generated a lot of questions by asking our clients what they wanted to hear about. And based on their feedback, we've compiled a list of questions and kind of put them into different themes or topics. So why don't we get started, Leo? If you go to the next slide, our first question, Francis, is going to be around reopening the economy. I know everyone is very eager to hear about your thoughts. So what do we expect the economy in Canada and North America from a reopening perspective from an event like COVID that we've never gone through? So do you anticipate this to be a one-shot deal, or do you think this will be from a phased approach? And what do we expect for the return to normalcy? Would that be hopefully this year, or are we kind of looking at more of 2022?
Wow. So first of all, I have to say I've done over 200 Zoom presentations since last March, and you were the first to actually put the question on the screen. Kudos. 200 presentations, and nobody has done this for me. Thank goodness, because I get rambling and then I forget what the question was. So this is already going great for me, Rahim. Thank you. Yeah, it's a good question, right? And it's sort of plagued us from the very beginning. Back in April, we set up what we called our 3-phase recovery framework, and it's worked pretty well for us so far. And if you followed any of my work, the 3-phase recovery framework we started with was we would begin with, starting in April, May, what we called phase 1, the rapid rebound, which we expected to be the slingshot of activity as everybody, as they came out of that first initial lockdown, went to get their, haircuts done. We expected this period to be one where you saw manufacturing activity take off really quickly. But we knew that even though we weren't anticipating a second wave yet, it would be really challenging for the economy to come back fully to normal. So we said that starting in about September, we would see what we call phase 2, the stall out. It's supposed to sound sort of nefarious, the stall out. And the stall out is a period that began in September that actually we're still in. And understanding our current economic environment is really critical. It actually comes down to human behavior. You don't even need to be an economist to figure this out. But the defining economic characteristic of our current economy is actually one of social distancing. And social distancing is necessary for our health, but it's also a significant strain on the economy. Why? Because if you go, to a restaurant, if you can, in Canada, we can't do that right now, but if you were going to a restaurant, you would notice that they cannot fill all of their seats at the table. They have to socially distance all of the table. You might notice I tell the story pretty often of, when we first came out of the first lockdown, the first thing I did was call my hairdresser, like most of us did. Why? Because the world was dangerously close to discovering that I'm not a blonde at all. I'm actually a dark brunette, and it was situation critical. So I called my hairdresser. I said, "You got to bring me in right away." And he said, "I'm sorry, Francis, I can't." And I thought, I'm a VIP. How could you not bring me in? And he said, "I can only bring in one customer at a time. And I have to schedule 20 minutes in between each customer just to disinfect. And then he said to me, you know, the hardest part about this, Francis, is that I can't make ends meet or pay my other employees, so I'm going to have to raise prices. And I could show you all these models, we could put slides up, but that single story is the defining characteristic of our stall out economy, which is that as long as we have social distancing in place, firms have to operate below capacity. They can't bring in as much revenue, and they have to increase prices. And this is why we have long said that you would see some mild inflationary pressures as long as we were stuck in this stall out phase. We often said the end of phase 2, the stall out, would come when the vaccine arrived. And this is why we're at a pretty critical point in the global economic story. I see your question, which is nicely on the slide, asks Canada versus North America. And here now we're at a problem because as many of us know, Canada is lagging pretty significantly on vaccines. And the US has already vaccinated over 10% of its population. This is going to be exacerbated by the fact that we have a new variant and we are expecting a third wave to roll through and through most economies. And yet the US is going to be more insulated to this, and they're going to get to move on to phase 3. And we're probably going to get stuck in phase 2 a little bit longer. I would say we're probably stuck in phase 2 until the middle of the year, until we can lift those social distancing measures. Another component of this that we realized about the stall out economy, the economy we're in right now, is there were a lot of questions about how much of the slowdown in growth, how many jobs lost were because governments shut our economies down, and how much of it was just because you and I, Raheem, are probably afraid to go out. If you could go to the movie theater right now, would you? I wouldn't. I would be really nervous about it. I get nervous going to the grocery store. This is pretty normal, right? So the IMF's done great work here, and they found that actually half of the drop in the economy is due to the government locking us down, but the other half is just due to you and me being nervous about going outside. So people often ask me, when do we get to the reopening phase 3? And my answer to them is just look outside your house. When do you feel safe going out? And that's when we get to exit and we go back to normalcy. It's that simple. Of course, a lot of economists will go on TV and give you complicated formulas, but it's not that. It's a confidence element. And then we'll enter into what we call the reopening. For those of you who are market focused, I think the reopening is already in the price. I think the stock market has already priced in the reopening. And here we enter a really interesting period where, as many of you know, the disproportionate impact on our economies fell to the lower income. It fell to racialized populations and exacerbated inequalities. The problem in the reopening is that those who are left behind in the reopening are those who lost their jobs over this period. We are going to see some pretty aggressive rehiring because when I feel safe, yes, I'm going to restaurants. I'm going to get like a nice salmon tartare on a salad bed or maybe a steak. I'm going to go to the movie theater. I'm going to go do those things. And I'll tell you what, though, I'm not going to go to the restaurant 3 times a week. I'm not going to go to double the amount of movies that I would have gone to. I'm not going to get 2 times as many haircuts. And I'm not going to get 2 lattes a day just because I missed my 1 latte a day during the past year. So when I think about the reopening, you're going to hear a lot of people talk about the pent-up demand. And yes, we're going to go back in line with our 2019 habits. I think there's generally too much excitement about the idea that we recoup much of what was lost. And of course, there's a lot of people saying, well, everybody who lost their job is going to be rehired. Well, there's 750,000 Canadians that are still out of work relative to last March. There's 10 million Americans who are out of work relative to last March. These people are not going to be rehired within a couple month period. It's going to take a long time. So I get accused a lot of being too bearish, too negative on the outlook, but I'm not negative on the outlook. There is a return to normalcy. What we find, though, historically is that these things take a little bit longer than everyone hopes. So 2021, to me, is not the return to normal, particularly in Canada. We're talking about 2022, I think. By mid-2022, I think we feel the virus is long behind us, and we've seen the bulk of the rehiring, and we're probably closer to full employment. There's one exception to this, and you're probably, Raheem, thinking, we only have you for half an hour. Let's get on to Q2. But this is the pinnacle of all of it, right? There's one really critical element here that worries me, and that is we have seen a drop in labor force participation rates from Canadians, but especially Americans. Why? Well, a lot of the research suggests it's actually moms with children under the age of 6. That is the group that dropped out most aggressively over this time period. And interestingly, not just low income, but it flows through to all income levels, right? So what concerns me, and I speak to the government, I've spoken to the Prime Minister about this, I've spoken to the Bank of Canada about this. What concerns me is that when people leave the labor force, they don't tend to come back in for long periods of time. You actually have to offer really aggressive wages, and that's for natural reasons, right? You lose your skill set, you lose your confidence. You think I haven't worked in a really long time and I don't know if I could get back a job. And even employers bias against people who have holes in their CVs. We know this, right? So what worries me is that segment of Canadians and Americans probably takes them several years to recoup. And that's really a step back for women. It's a step back for equality, and it hurts our economy over time. So that's the area that I worry. We have a lot to talk about. So hopefully that gives you sort of a base understanding of where my mind is at.
Yeah, absolutely. That was great. And one of the things that you mentioned earlier on in your remarks was around inflation. So I think that's a pretty good segue into the second question that we have. So we know that countries globally have increased the amount of spend from a fiscal and monetary perspective. We also have, prolonged period of low interest rate environment. How do you think this will factor into the economy? And those, to me, could be recipes for inflation. What are your thoughts around the long-term impacts of these policies?
There's a couple things going on here. I am not afraid of inflation. I think in the very short term, we are going to see some sizable price pressures in a couple areas. So I'll just walk you back where we're coming from, because you're going to hear newspapers talking about inflation a lot in the next 6 months. Do not fall for it. Here's what happened. In the middle of the crisis, there was suddenly a huge demand for goods. Think Pelotons, right? But also manufacturing goods. A lot of companies were trying to build up inventories. How many of us went and bought rolls of toilet paper or bleach or even just cans of things or needed to buy Zoom equipment? So what we saw is that the demand far outpaced the supply, in part because also manufacturers were being slowed down by social distancing. Even plants had to have people that were separated. And a lot of people got sick in manufacturing warehouses. This is, I think, vaguely underreported, but it meant that these places were operating in half capacity. So we saw ports that were being stalled from accessing activity. I have a colleague in Hong Kong who was telling me her children were very upset over Christmas that they couldn't get a real Christmas tree. And I said, well, like, why? Are you Scrooge? What happened? And she said, the ports are so clogged that in order to get a North American Christmas tree costs you the equivalent of $800 American dollars. So no, we can't get any. Now, a lot of people are going to say this is inflation. This is not inflation. This is supply chain disruptions that make it more challenging to access goods, so prices rise. You can see my TED Talk actually on a basic explanation of why prices rise based on supply and demand. Now, as we go into the reopening, people are probably going to stop buying Pelotons as much. We're going to have more people in plants, so that goods price inflation is going to fall down. And yet I think a lot of us are maybe going to want to go on vacation. I wouldn't be surprised if airline tickets become more expensive. Even, if you want to go to your hairdresser, they're trying to recoup some costs. You could see services price inflation come back, and certainly housing prices going up at the same time. So you'll have a switch. Now, what worries me is not at all what's happening in monetary policy and low interest rates. The reason for that is we still have these massive deflationary forces that are structural in nature. One of them is demographics. We know that as our populations get older, they save more. It puts downward pressure on inflation. We know that very large debt levels actually create very low levels of inflation over time. And the biggest obvious one is digitalization. Our digitalized economies are profoundly deflationary. Think of how many things because of the internet you access for free. I don't even pay for music anymore. I just stream it on YouTube. How many times have you gone and gotten, a free yoga class online, or even just the access to information is now freely available based on our internet connections? I was saying earlier before the call started, we We moved from Toronto to Montreal in the middle of the pandemic, and because of COVID, we didn't hire a moving truck. We just drove our SUV back and forth along the way. And at one point, it actually broke down on the side of the 401. And I was all panicked because I was thinking, oh my gosh, I completely forgot to renew my CAA. And, we're going to be on the side and there's no tow trucks and it's COVID. And my husband said, don't worry about it. I'm just going to rewatch a couple YouTube videos and I'm sure I can figure it out on the side of the road. And exactly, he did that. So first thing to say is actually that was pretty darn attractive. I did not know my husband could change a tire on the side of the road. Very good for our relationship. But secondly, through the whole thing, I couldn't help but think, wow, this is so deflationary because we didn't end up paying for anything. We didn't pay for the information and we didn't pay to have it done. We did it ourselves. So these are the disinflationary powers that are coming forward on our economy that are really challenging to fight against. Some people are saying that even though we have these downward moves in inflation, there are, inflationary impacts on the other side that are going to offset that. And one is very low interest rates. This is a misnomer. The stimulus that's in the system only creates inflation when it's actually spent broadly, and it's not. Banks are hoarding that cash, and we learned this lesson after 2008. Where I have more sympathy is the amount of government spending in the system, because the amount of government spending in the system doesn't sit at banks. It goes into our pockets. And you may have heard Deputy Prime Minister and Finance Minister, did I get it right? Chrystia Freeland. There's many titles there. So she was criticized at one point for saying the savings from CERB checks are our stimulus. Well, that might not have been a great political commentary, but it was actually factually true. Now, what we need in order to create inflation is for people to spend that money out in the real economy. So we were joking earlier that I tried to hire a landscaper. They're in so much demand. They said they could do my flowers for, I kid you not, $100,000. I'm not getting flowers with them, just to be clear. Why? Massive demand and massive spending that's coming from CERB checks and low rates. But here again, I have some concerns. When we look at survey data, what we found is people spent some of the money and they saved some of their money. Do you know what Canadians and Americans are doing with their checks? They're paying down debt. We're actually in the middle of a deleveraging, and very few people talk about this. And it's very exciting for me because this is the first time in my career when I can say I've actually lived through another period in history that's relevant to the current economy, because I was working in 2008 and I know what a deleveraging looks like. When people pay down debt, it's very good for the long-term economy, but it's challenging for the short-term economy. It doesn't create inflation. Paying down your mortgage, paying off your credit cards, paying down your line of credit doesn't create inflation because that money is not flowing through the system. So how this money is spent from government is far more important to the inflation outlook than just how much it is. It's also far more relevant to the growth outlook, how it's designed over time. So if you're giving checks to households, for example, we find that the what's called a fiscal multiplier on that is lower. A fiscal multiplier is if the government spends $1, how much growth does it create? Typically with checks, we find that $1 of government spending creates less than $1 of spending in the real economy. Whereas when you spend $1 on infrastructure, highways, public transit, it can create up to $4 in the system. So you can actually see 4 times your money come back. An interesting one is childcare. Childcare, $1 spent can create $1.40 back into the real economy because it boosts labor force participation rate and it helps boost growth over time. So not only do you get all of that money back in tax revenue, but you grow the economy. So the how around it is what generates inflation and growth. And I think too many people are just focused on headline numbers and not the how underneath it. All that said, my inflation forecast before COVID was 1.5 to 2. After COVID, it's 2 to 2.5, so it's a little bit more, but this is not going to be 1970s style inflation. Does
Perfect.
that answer the question? And maybe 8 others?
No, that's tremendous insight. And I think a lot of people, the takeaway will be, chalk it up to a little bit of media hype, but overall things shouldn't spiral out of control. So that leads us to our next question around technology. And hey, a deflationary a theme with technology. So the question was, while technology advances are generally a net positive on society in the long run, they tend to create disruption in the short term. What changes should employers expect with with the labor markets going forward as it relates to technology?
So directly where we expect the most technological disruption is actually in education and healthcare. So this concept that you need to get your best education, particularly in the United States, sitting in a traditional classroom, I think is being challenged. And we also expect, particularly in the US and globally, that healthcare goes more online as well. Some people don't like this. Like I have a lot of friends who had babies this year who are holding their baby upside down on the Zoom camera trying to demonstrate. But my husband and I both had our quarterly updates with our doctor over Zoom, and I asked him, are we still going to do this on Zoom? And he said, well, why not? I don't need to physically examine you. It's just a conversation. These things will continue. I do expect, I mean, it doesn't take an economist. Everybody on this call will understand that we've proven we can work from home on occasion and still have some productivity. No research I've seen tells us that any major shops, with some small exceptions, will be entirely work from home. So the concept of the office space is probably going to change. And with it, my expectation that people continue to move further out of urban centers, and that they consider not necessarily living in Toronto or Vancouver. That, of course, motivated my move to Montreal, that I recognized, okay, I would still have to get to Toronto on occasion, but I could live in Montreal where the cost of living was more appropriate for me. I could be closer to my family. So something we talk about a lot is the, suburban real estate, but also suburban corporate real estate, that there will be a pushback against exorbitant high cost of living and allow for different types of suburban or even rural living in the sort of new paradigm. And to me, that's the biggest story. And of course, it flows through into where we think housing prices go and corporate real estate and the whole way that we function. At one point, I remember having a conversation with a portfolio manager like 4 or 5 months ago during the second wave. And he said, I think I really want to buy Delta, the airline. And I thought, airlines, are you nuts? I can't think of something I like less. And he said, Francis, I suspect that we actually see more corporate travel in the future world because more people will be leaving city centers. Corporations will say, I don't have to be in San Francisco. I can be in Austin. I don't have to be in Toronto. I can be in Montreal. I could still have all the efficiencies, and then I will actually fly people in and out a little bit more. So I'm not advocating buying any specific stock. I'm not allowed to do that. But I did think this was interesting, that to me, it's not about are people working from home 4 days a week and 1 day a week in, at or vice versa, 4 days in the office, 1 day at home. It's where do people want to live, and how do companies accommodate not just longer commutes, but actually different cities. I think that'll be really interesting. I suspect we see more outposts over time.
Agreed. And you mentioned an airline story, looking at companies like Teladoc and Chegg, which focuses on education. I think, the price in those equities tells you where the market is going from a technology perspective with healthcare and education. So absolutely, we agree with that. And thank you for your thoughts. Question number 4 is around deglobalization. Now, I know for the last, several decades, we've talked about making the world smaller and the concept of globalization. But we noticed that early in the pandemic, there was a supply chain issue around PPP getting to Canada. And now, as you mentioned earlier, Francis, with respect to vaccine distribution, during the Trump presidency, we had tensions between the USA and China. So do these themes then take us to a world in which deglobalization is going to be your trend? And what does that mean for Canada and industry maybe coming back to Canada? Are these net positive events? What are your thoughts on that?
Yes, we will. We are in deglobalization. Deglobalization probably began in 2016 and persists. And I think one of the more interesting developments is that, the Biden presidency in some ways is even more hawkish on China than the Trump administration. They're not rolling back any tariffs. I believe I saw President Biden the other day say China will eat our lunch. That's not something one might have thought would come from President Biden, but a very clear example that there is a populist shift occurring that is relevant to deglobalization. So I have a piece, you can get it on the Manulife website, that I call 7 macro disruptors for 2021. And the 7th one is a rise in populism and demand for redistribution. And this is related to your question, because what we've seen is, mass levels of inequality are triggering a demand to reevaluate our economic system. And I'm a good Bay Street economist. I don't question things. I follow my textbooks, but I think it would be wrong to ignore this socioeconomic, sociopolitical shift that is occurring beneath us. Your comment on PPE is very interesting because I do have the opportunity to speak regularly with governments, and it's always surprising to me how mainstream economics has not referenced how painful it was for Canada to not have its own supply chain. And we're seeing that now as well with vaccine distribution, that, why can't we make it at home? There were also, it's not relevant as much to Canada, but countries that were worried about food supply. Do we have our own food supplies? So on a very small basis, I do expect there's going to be more nationalistic tendencies. But what I think is more relevant in the current environment is I don't think that we stop trading with everyone globally. What I do expect is more regionalization. So it's more likely that the US-Canada relationship becomes more economically important, even though it's pretty hard. It's like 3/4 of our exports. That the intra-Asia relationship becomes more important, that Europe becomes its own trading bloc. So deglobalization maybe is too extreme a word. What we need to focus on, I would not say deglobalization, I would say greater regionalization that occurs. So for Canada, that's a bit challenging because we are a small economy. It also means slightly higher prices. So again, we're talking about incremental increase in prices, but I suspect because we have this big surge towards more nationalistic tendencies that people will be happy if they see a made in Canada to pay just a little bit more for it. So it is at the margin inflationary. It's also one of the reasons why we have that slight increase in our post-COVID type of inflation perspective. And I do think it's relevant. To be honest, what it really does is make me bullish emerging markets. It makes me want to invest more heavily in Asia because they are the net beneficiaries. They're the ones that will benefit most aggressively from more regionalization.
Perfect. So just to do a quick time check, if we could get one more question in, Francis, are you okay with that? Perfect.
Yes.
So, you mentioned emerging market, and I swear we didn't rehearse this, everyone. So that takes us to our next question. And as a group retirement consultant, we help plan members construct their portfolios. And as you know, from a product perspective, we tend to have a lot of product that, where fixed income is mandated within the portfolio. So we are in a very, very low interest rate environment. And I wanted to get your thoughts around, what does it mean for a plan member who has a traditional, 60-40 portfolio? Like, are they forced to go out on the risk curve into whether, as you said, emerging market or real estate, or, the emergence of, and don't laugh at me, cryptocurrency. So I just wanted to get your thoughts on that while we have you for a few more minutes.
So Rahim, I said I have 7 macro disruptors. My second macro disruptor is the rise of alternatives, including crypto. So no, I'm not laughing at you. I'm actually more concerned about people who dismiss this entirely. Not because I think crypto is necessarily a good investment. That's a personal thing. Doesn't necessarily mean you should be in it. But there's a messaging here. As I say to my team all the time, don't come in and laugh to me about what Bitcoin is doing or Robinhood is doing or Wall Street Bets is doing. Tell me what it means. What is the signal that we are getting from this story? So we don't expect rates to rise for 4 to 5 years. Yeah, the long end of the curve is going to seep in, but central banks are going to keep rates very low for 4 to 5 years. My 5-year asset class return forecast for global government bonds is 0.5% over 5 years. So you can keep your 60-40, but don't expect the returns you were getting in the past 10, 20 years. So you're just going to live, we call it a half return world if you do that. So what do? Well, you can do 3 things. Well, first and foremost, you should have someone helping you with your asset allocation. Like you should be working with Penmore. That's number 1. or equivalent, but I feel like Penmore is really good. Number two is you have to move further out the risk curve. There's really no choice. And the relevancy of this is people say to me, why is there such a disconnect between equities and the real economy? Well, not really. Terrible real economy means very low interest rates. Very low interest rates mean I can't hit 6 to 7% on my portfolios. So I have to go further into equities. And what I feel is underestimated is large asset managers, pension funds, and institutional money are still very, very underweight equities on a structural basis. So you will just see more money flowing in. Does not mean equities go straight up. Does not mean they go straight up. But I think equities are under allocated too. I do not believe that the asset allocation portfolios of the future are only 60-40 stock bonds, because I also believe, exactly as your question says, you have to think about alternatives. I don't think of emerging markets as alternatives, although I understand that comes through. It is much higher yielding. Emerging market debt is one of our most preferred investments over the long-term horizon. But we also might want to start thinking about things like hard assets, private assets. So real estate is an important component of our portfolio, even though everyone thinks real estate's a disaster. No, it's a hard asset that's more difficult for central banks to print. And it's firm, and it provides a little bit of that inflation protection. What about things like agriculture or infrastructure funds? These are really interesting, I think, investments that are part of the portfolios of the future. Now, cryptocurrencies, I think there are other ways you can achieve what crypto is doing for you, but cryptocurrencies are telling us something very important. They're saying there's a thirst for alternatives. The people, the investment community would like things that central banks cannot manipulate, and potentially governments who are driving up huge deficits cannot tax or regulate to the same extent. So there's a messaging there. To me, we don't invest in crypto, but to me, it's a signal that alternatives are a critical component of the investment outlook. But you don't have to go into, these crazy alternatives. You can just be thinking about what's different than a 60-40 TSX Canadian government bond that I can do that maybe has a little less correlation with the S&P, is maybe a little less influenced by central banks, is hard, real, tangible. I strongly suspect that this is where the investment portfolios of the future are going. I think this is more challenging for people to passively replicate in the market, and there's going to be a lot of value on active management and people who help you navigate how to develop these portfolios of the future. Or else, as we said, your 60-40, sure, it'll work, but half return world.
Perfect. Thank you so much. And I think this was terrific. We really appreciate you making the time for us, Francis. We want to respect your time. So once again, thank you. And we will continue the presentation with myself. But Francis, once again, really appreciate it, and have a great weekend.
It's a pleasure. I hope everyone enjoys the week.
Thank you.
Thanks,
Take care.
Bye.
Bye-bye. Well, thank you everyone for tuning in. So just for a couple of minutes, I wanted to reiterate what Francis mentioned. And throughout the entire period since COVID began, we have, as you know, a retirement consultant. We help a lot of different corporates and their employees manage their retirement outcomes. So we have really kicked up our efforts in doing just that. So I wanted to just give you a little bit of an update on what we've been doing and how it's been working. One of the things that we continue to do is provide education. As you can imagine, it's been a very hard to actually do this in person, but we've had a lot of great success providing ongoing education over Zoom. We've done, 50, 60, maybe even 100 sessions. So if you are a Penmore retirement client, this is something that if you haven't taken part of, we strongly suggest that, we are happy to help your employees navigate these times. The next theme is around diversification. So as Francis mentioned, the traditional 60-40 portfolio may need revision. So you would have heard us talk about target date funds and asset allocation funds. These products tend to have sleeves where you get exposure to alternatives. So keeping in mind that there are asset classes and product solutions that are available for your plan members. So we're not stuck, with having one bond fund and one equity fund. There's a lot of great product, but we continue to reemphasize the importance of a fully diversified investment portfolio. And we are helping your plan members with that strategy. And again, we want to reemphasize with all plan members and to everyone on this call today is we need to think about the long run. Retirement money is meant for just that, for retirement purposes. So we don't want what you see in the news to turn you into someone that loses focus of your goal, which could be 20, 30 years down the road. So I just wanted to provide everyone with a little summary of what we've been doing on the group retirement side. And if anyone has any additional questions, please reach out to our team directly, and we'd be happy to answer that. Leo, I know we didn't mention anything about Q&A. Do we have any questions at all on the chat that we can help with right now?
Not right now.
No. Okay. So my apologies. If you do have any questions, as I said, please reach out to us and we will make sure that your questions get answered. I'm hoping that everyone enjoyed this session. Before we say goodbye, I want to turn it over to Tyler, who will be introducing our speaker for the month of March. Thanks, everyone.
Yeah, thanks, everyone. That was a really great presentation. Thanks for the team for setting that up. I thought Frances was quite a great speaker, so I'm really, really glad we got her on, and we're following that up with what I think will be another great speaker. So Julie McCashin is the Senior VP for Health Services at International SOS. If you don't know who International SOS is, they're kind of the global leaders for travel assistance, evacuation, those types of concerns and products. So they know the world market from a healthcare and a security perspective really well. And Julie is obviously an expert in this space. So what Julie is going to be talking about to everyone who is able to attend is return to normal. And that's going to include a whole bunch of data and information on vaccine rollout, which is obviously top of mind for everyone, and what the availability is going to be like, and how that's actually going to help organizations envision a timeline of when they can get back to something resembling normal, and maybe a new normal, maybe some equilibrium that we're not sure what it's going to look like yet, but gives organizations an idea of what they can look forward to in the near future. I think, myself included, this is going to be something that people are quite interested in. I know, especially in Canada, there's been a lot of vaccine talk. So Julie's going to be able to give us kind of a bit of an understanding of how that rollout is looking like around the world, and how that's going to impact business, and how businesses can actually use that information to make sure that they're prepared going forward. So that's going to be at March 12th, 1 p.m. Eastern. We will send an invite out with plenty of time. I know there's maybe a few too many invites this time, and this next time we're going to try and make sure we get it as smoothly as possible. So please bear with us. But yeah, hopefully everyone can join us for that, and it should be a great presentation. So with that, I think we're about wrapped up. I don't see any questions. So at that point, I think we can let everyone go and enjoy the rest of your afternoon.
Yeah, everyone have a great long weekend if you're celebrating Family Day. Thank you very much, Tyler and Raheem, and look forward to our next session.
Thank you.
Thanks, everybody.
Bye.